This is the Working Investor. In this video, we're going to talk about a really cool secret hedge that hardly anybody is talking about that is doing outstanding performance in this crazy market when the market is down 10.5%. And this hedge is none other than SHLD. Sounds like SHIELD because it is Global Defense and Tech ETF. So this is very unique. It's a cross-section of not American, but it's global spending on defensive technology, which makes this go up. I wanted to do a shout out to one of my friends, Axel. Very smart guy. He pointed out this ticker symbol, and the more I've been reading up on it, the more I'm amazed. Nothing here is, as always, not financial advice, tax advice, legal advice, or any form of advice. This is for fun and entertainment purposes. Please counsel who you need to counsel. So what is it with this SHLD? And why is there are other ETFs out there on the block that are aerospace and defense technology, and they've been around for many years. What makes this better? So let's take a look. So I went on thefool.com and I was looking at some competition out there. The number one competitor is ITA, which is iShares Aerospace and Defense. This has 6.3 billion in net assets, and it's basically more domestic of aerospace and defense and commercial aerospace industry, which is not necessarily defensive. Like, for example, Boeing, some of their holdings are General Electric, which you wouldn't think is a defense company, right? And I kind of looked at a few of the other competitors. So number two is the PPA from Investico or Invesco. And you can see, again, it's a big emphasis on U.S. defense, homeland security, but not global, and you can see, of course, Lockheed Martin, RTX, General Electric as well, Boeing, not necessarily, defense, could be aerospace, et cetera, et cetera. And of course, ARC, of course, Kathy Wood's got one, ARC X as well. So let's go ahead and compare all these together, and we'll talk about why SHLD could be a better hedge, not just a performer, it is a better performer, but also a better hedge against the S&P 500 in general. And I'm going to explain this all to you right now. So I'm pulling up the 1-year chart because SHLD, like SHIELD, came out about a year ago, a little over a year ago, in November of 2023. So I'm pulling up total return in case anything gives dividends. So you can see the S&P 500, we'll use it as kind of like a baseline, and we want to basically have a hedge against it. And you can see it's 5.19%. SHLD, 58.29% year over year in total return. Way more than the S&P 500. ITA, we spoke about, that's the largest, aerospace defense. More, 18.26, not too bad. PPA, another one, 18.5%. XAR, 24%. ARC X, 25.75. And DFEN is a triple leverage defense ETF. I won't go into this in too much detail. It's a lot of risk, 26%. But even without using triple leverage with volatility drag, SHLD is doing better. So why take on that extra risk, right? Let's look into SHLD a little further. And before we do, let's look at our why, right? So we're looking at correlation coefficient. How much of a hedge is it against the S&P 500? So so if you look at SPY versus SHLD, it's 0.53. So it's moderately correlated, but not high. But if you compare SPY to ITA, which is the competitor, it's a higher positive correlation. So it has more correlation to the SPY. So that's why SHLD is more preferable in my books, because it's providing me good growth and a better hedge because there's more of a divergence against the SPY. And if one is very heavy in the NASDAQ, in the Qs, you can also see that the Qs also, it's 0.53 correlation coefficient. So it does show moderate positive correlation. But if you compare it to ITA, it's much stronger correlated. So Hence, I'll pick SHLD, better yield and better, hedge. Why not? And if you want to go really technical, something called Sharpe ratio, which teaches you about what is risk adjusted return. I've made videos on the Sharpe ratio. So the higher the Sharpe ratio, the better risk adjusted return. You're getting the most return for the amount of risk you're getting if you have a higher Sharpe ratio. So, the second one is the S&P 500, the regular. So it's a 0.8 Sharpe ratio. And then the top one is IVV, which is more of like a value play, and that has a very good Sharpe ratio. You get a very good return based on, is it max drawdown versus max gain. And then SHLD, you could see for a technology defensive company, you're getting a better, strong risk-adjusted performance in the defense tech sector. Compare it to ITA, which is 0.86. So you see you're getting a better risk-adjusted return. Now that you're interested in it, let's look into the SHLD. So this is from Global X, going from their website. And the key driver is the demand, right? So they talk about, since 2020, global defense spending has grown at a 4.2% annual rate, about 4 times higher than pre-pandemic levels. Spending is expected to grow at a 5% annualized rate to $3.4 trillion in 2030. I checked with ChatGPT how much the spending is on defense globally. So as of 2024, global defense spending reached a record high of approximately 2.46 trillion with a T. And if you look at the conclusion, with global defense budgets at unprecedented levels and a growing emphasis on technological advancements, the defense technology sector presents a unique investment opportunities. Its moderate correlation to the broader market further underscores its potential as a diversification tool in investment portfolios. And we've all heard of Palantir, right? But why just invest in Palantir single stock risk? If you love it, great. I don't, but this has a whole basket, including Palantir, right? So they're saying that governments are increasingly reliant on advanced military systems that require specialized hardware, creating demand for sensors, artificial intelligence chips, and other processing network solutions. And look at the key word in this last sentence. So defense tech spans sectors like industrials, cybersecurity, AI, and augmented reality. Unlike civilian markets, defense revenues are closely tied to military needs and are not necessarily linked to economic cycles. So when there's economic turmoil, sometimes the military has more needs. So therefore there's more spending, and therefore your once holding potentially would go up more, where if someone has their classical technology stocks may go down, these things actually may go up. Their expense ratio is 0.5%. And if you stick to the end, I'll show you how to make money off it as an income, because there are no income funds on this. I thought it was pretty funny that the inception date was 9/11, but 2023. I thought it was pretty funny. So the key thing is the holdings. So they have 37 holdings, not the greatest amount, but a decent amount. And here you can see a whole list of their holdings. Their second top holding by weight is Palantir of 8.87%. They have Rheinmetall. So they have basically all, if you go down the list, they have US, they have non-US. Let's take a look at the basically the allocation. If you scroll down, you can go by country, and you could see 54.1% by weight of this ETF is US. That means about 45.9% is almost half is non-US. So this is basically like a mix of domestic and international. Why limit yourself just with domestic when, there could be other countries out there making amazing technology and you get exposure to all that? Obviously, hopefully there's no wars or anything. Sometimes if you want to have peace, you need to prepare for war, and they can have peace. Some smart person said that. I guess that was Publius Flavius Vegetius Renatus. So that's why I couldn't remember. Oh, that's the saying. That's the classical saying. I don't know where that came from. Some Roman author. So as promised, let me show you how I have made some money off this fund, like an income fund, and how if somebody wants to hold it, they can use it. So basically, I'm going to say we're going to do some options. So if you go to trade trade options, right? So I like to go as far out as possible. Unfortunately, there isn't enough liquidity. So the furthest out you can go is December 2025. So you go about 5-6 months out. And let's say if you want to go buy call, and so it's not the best. I'm going to be completely honest with you. So if you go because of liquidity as of now. So if you go to buy call, I'm looking for a 0.7 delta at least, but also looking for like an even number, like a 45 or a $50. So I may go to the $45 strike, for example. So if I do buy call, you could see I set it up that it's a 0.75 delta, so it's deep in the money. My break even is 54. So if you add the $9.10, it's $54.10. So I need the stock to go above $54.10 at expiration, right? But if it goes even $5 up, if it goes right now, so you can see it's trading on here, a price of $50.75. If it goes up to even $55 tomorrow or next month, I could still sell out of this and I can get a good, I can pretty much get a profit. But if you do buy call, now you're spending $910. But then let's say if you want to sell a call, a short call against it, remember your break even, what do we say? Your break even is 54. So let's try to do a 54 or $55 strike price. So sell call May 16. I remember the liquidity is not that great. So you go to a $54 strike price, you could make about $53, or you can go to a $55 strike price and make $23, which does not sound like a lot. But while you're holding it and getting exposed to it, you can make money while it goes up. And if you want to make money while you're holding it, you could sell a short call against it. Again, liquidity is not that great, but that is a possible way to kind of turn this into some kind of ETF. Or you can do, obviously calls and stuff like that on the actual underlyings like Palantir and other stuff. But this gives you a pretty good diversification. I'm looking to possibly add this. It's a watcher. I may want to add this as a small position. It may not be a big position in my portfolio. If it's in my income portfolio, I would try to make some income off it. If it's not, then just if it's in my growth portfolio, it'll just be growth. But this is something that I am interested in looking into further. Let me know what you guys think. Do you guys think that defensive technology specifically is a really good way to have a small portion of one's portfolio as a possible hedge, not financial advice? What are your thoughts about this? This is The Working Investor, over and out. Have a wonderful trading week.